Hello, everyone, and welcome back to Your Finance TV. What a treat it is that we've got Jay Pelosky back with us to give us his monthly breakdown on the markets. How are you, Jay?
Very good, Scott. Great to be with you.
Okay, the title of this one is The Age of Investment. And the first thing I jumped to is The Age of Ultron. And now I'm going to say that you haven't seen any Avenger movies, but talk to us about The Age of Investment.
Well, you're correct. First off, I've never seen an Avenger movie. My kids are too old, I guess, and that's just not my thing. But yes, the age of investment, and really, it's been kind of in the air over the last couple of years, right? The spending post-COVID, the spending on climate, but the penny really dropped for us here at TPW Advisory last week with the earnings results from some of the Magnificent Seven, where they detailed just absolutely massive investment spending plans over the next few years to ensure that they remain competitive in the new AI age. So, as an example, both Alphabet and Meta announced that they would spend somewhere on the order of $45 billion each over the next year to maintain and grow their AI footprint. And so that really just kind of, the penny just dropped for us that, wow, this is not normal. This is not what we've seen. We know that 2010 to 2020 was a period of low investment, low capex, low growth. Banks weren't lending post GFC, et cetera. Today, we have a very different situation, right? We have cash rich companies. We have VC and private equity firms with trillions of dry powder. And we have governments who are recognizing the existential threat, both from climate and from AI, which means that they are going to keep the printing presses on. And so for us, this just really spoke to us as like a big change, a big theme, something we want to really try to wrap our hands around, which is the purpose of the monthly, really dig in to how we see things playing out. And so there's really two areas of focus for us. One is this twin engine nature of the financing side, of the investment side, cash rich companies, governments with printing power. The other is the capacity of the physical realm and the digital realm. So go back to those Magnificent Seven in AI. That's the digital realm. That's being built out in a global fashion in real time with existential threats to those companies that are not successful. And countries as well. Every country needs to have its own sovereign AI. And you see this playing out all around the world. At the same time, we see reports from places like Morgan Stanley and JP Morgan of major copper shortages starting to manifest. And we've talked about copper and copper miners as being a key position for us over the last several months. But here too, it's the joining together of the two trends, which is really fascinating. So one of the drivers behind both these big firms coming out and saying, hey, this copper shortage is actually coming at us much quicker is because of the need for power from the data centers that are driving the AI compute process. They are very power hungry, which means new power required, which means more copper used. And so you have these two factors playing out, which really do two things for us. And then I'll stop and take a breath. The first is that it really reinforces our kind of blue sky global macro outlook, right? Which we've talked about now for the last 4, 5, 6 months. We are of the view that 2023 through 2027 is effectively going to be a period of blue sky opportunity for global macro, much as it was in 1995 to 1999 within the US, which was the last time the US had a capex boom, a productivity surge, which led to high growth with low inflation and very good returns for risk assets. The difference this time is clearly it's global. AI is global, climate threat global. Thus, all countries, companies are responding. And then the second is the opportunity for us to participate as investors, right? And so we really see two areas where we want to be very focused. And both, incidentally, are what we call picks and shovels. So we want to be in the picks and shovels of the digital age, which is the semiconductor space. And we want to be in the pick and shovel in the physical realm, which is the miners. So copper miners, as we've talked about, we've mentioned uranium miners before, gold miners, etc. We want to be kind of at the rock face with our picks and shovels because we see that is really the area of opportunity. And then I'll finish up just one more point. I almost forgot. Don't want to forget. Two catalysts. One we've touched on the last couple of weeks, which is our two tech stack divide thesis, arguing that both China and the US are now ring fencing their tech stacks, meaning that Chinese companies will dominate China tech and US companies will dominate US tech. That creates, in our view, a huge opportunity in China tech. And again, we've talked about KWeb with you many times over the last couple of months. Happy to report KWeb is up 30% over the last 3 months versus 0 to down slightly for US tech. So China tech has been an absolute monster outperformer over the last 3 months, virtually no one paying any attention. We think we're early innings here. And then the second catalyst pertains to the physical realm on the copper side and the mining side is the dollar. And we are setting up, we believe, for a period of dollar weakness. Most everybody else you listen to, you read about is dollar strength, the wrecking ball of the US dollar. We think the dollar is likely to roll over if we're at peak inflation fears, as we see markets reacting to slightly softer job numbers today, whether it's a potential second Trump term with worries about tariffs, whether it's the ECB cutting rates in June and the euro rallying because it's pro-growth, whether it's the yen rolling over at a period of time where net speculative shorts are at a 15-year high on the yen. We think the yen, dollar yen, could be the next momentum trade, much like cocoa, if anyone's paid attention to cocoa over the last couple of weeks. Huge spike and then a massive collapse. Dollar yen is probably 40 to 50% overvalued, and the speculative short position is at a 15-year high. We're watching that very carefully. And that dollar weakness, should it transpire, gives commodities and our emerging market equity exposure another leg up. I know that was a lot. It's a monthly.
Well, listen, it's all very interesting. Things I've been talking to about with a lot of different people. But for viewers, just as a reminder, this is the monthly, and we sign up at Pelosky.com or definitely click on subscribe on YouTube to follow these sorts of videos. We go through, and I'm going to do Jay's trick with his hands, like right up here. We go through climate, economics, politics, policy, markets. All the fingers out there, Jay. Let's start with climate.
5 fingers, baby.
Let's start with climate. And you note there, you talk about China's dominant position. We've mentioned that several times in these videos. But let's talk about where is the US and Europe on this front?
Yeah, you know what's really jumping out these days, Scott, is that China has established a position of dominance in the 3 leading areas of kind of renewable power. So solar, wind, and EVs and EV batteries. And it's just really becoming very clear, particularly as they start to export into the US and into Europe, which is leading to a response by Europeans and American policymakers as you suggest, because look, it's creating a conflict between two important goals for European policymakers and American policymakers. Goal number one is we got to deal with the climate. We have to try and meet our climate targets. It's becoming ever clearer that climate change is real, creating massive storms and chaos across the world. So we have to deal with that. Goal number two is we want to have our companies, our European companies, our American companies, to be the ones doing the work. The problem is that to really achieve goal number one, deal with the climate, the cheapest, best, most effective way to do so would be to leverage the Chinese companies that are already leading class providers. We think of BYD in electric vehicles, taking the crown from Tesla as the biggest EV producer in the world. You think of LONGi Green Energy and solar, the dominant solar player in the world. So the problem with doing that, of course, is that you then create issues for your domestic suppliers in Europe and the United States. So what's the solution? I think we're seeing it already. The solution is tariffs in the case of the US in Europe, which creates incentives for Chinese companies to set up production in Europe and in America, and thus giving jobs to Americans and Europeans, et cetera, while the Chinese companies continue to make money. And so we're seeing that play out in real time. And I just would note, as we show in the monthly, that China offshore foreign direct investment, so China investing outside of China, is at an 8-year high. And that is starting to become clear as they build up their production capacity for solar panels, for EVs, for batteries, et cetera, in Asia, in Europe, and in the Americas. And so the point that we would make, ultimate point back to our age of investment, is that all this reinforces the age of investment.
Let's move on to economics. And obviously, there's some words floating around this week, well, the last couple of weeks: stagflation, the inflation, transitory, definitely not being used right now. Should we be getting worried about all these data points coming at us, Jay?
Well, we agree with the chair, Chair Powell, the other day when asked about stagflation and his comment about seeing neither stag nor inflation. We thought that was pretty good, and we would subscribe to that. And look, the way we're thinking about things is that we see in the US and Europe, in much of the developed world, and increasingly in the emerging economies, fully employed populations consuming, while cash-rich companies and policy-driven governments invest. And we see that as really underpinning our blue sky global macro outlook for the next several years. In other words, you have the consumer side humming because people are employed, making money. We have the investment side starting to hum, manufacturing starting to pick up. And we have some great charts from B of A who do really nice work on global signals. Some nice charts demonstrating the manufacturing pickup. I mean, to your point about data, everybody focuses on PMIs or ISM or this data point or that data point. We like to see, because we're global and we're macro focused, we like to see work like B of A is doing, which shows the global manufacturing picture. Excuse me, not just the US picture. And that, by the way, is pretty robust. So look, we're not sweating every data point. We don't think one should, right? We have a very clear view of how we see the future playing out. The work that we're doing, this investment work, this monthly, a lot of work, 7,400 words, 34 charts and tables from 25 different sources, gives us comfort that this runway to the next couple of years of better than expected global growth, that we're early cycle, not late, is reinforced in our view. And so, we remain happy to trade rate cut hopes for earnings growth. And that's what we're seeing, right? We're seeing the market take out 4 or 5 or 6, depending on the day, the week, rate cuts, and yet the S&P is up, 6-7%, depending on the day, year to date, while ag bonds are down a couple percentage points. So commodities and equities have been the leaders. That tells us, we wrote a piece, listen to stocks, not Vox, a month or two ago. That tells us commodities leading, equities outperforming bonds, that the markets are telling us we're in an early cycle global economic growth environment, and we don't need to sweat every single data point to confirm that reality.
Let's move on to politics, and that's never my favorite subject, but obviously the US election, everyone sees the noise there, but there's more than just one US election on the globe. We have a lot of viewers actually from India, so you want to touch on that one as well, Jay?
Yeah, well, India, of course, has the distinction of being the world's largest democracy. It's also, probably in line with that, the world's longest election cycle. I think the election cycle in India, which is currently underway, goes for 7 weeks, and there's not a whole lot of surprise expected, right? President Modi is expected, and his party is expected to kind of continue to lead in India. The opposition remains kind of fragmented and not really putting up a strong counter platform, shall we say. And so India, while important, is not really getting a lot of investor attention outside of India, nor, by the way, is Mexico, where Mexico is anticipated in the next couple of months to elect its first ever woman president. So that's not getting a lot of attention. It really is the U.S. presidential election. And interestingly enough, though, when you look at recent polling, J.P. Morgan did a poll at the IMF meetings a few weeks ago. Only 12% of those polled felt that U.S. elections were going to be important to the markets. There's much more concern about inflation, much more concern about geopolitics. The U.S. election actually came in, I think, 4th amongst major issues from an investor perspective. But one thing we noted, and we have a different point of view on, is 70% of those surveyed thought that there would be a divided Congress. We actually think, in line with our view, that President Biden will win re-election in a landslide, which is not a consensus view. We actually think the Democrats stand a pretty good chance of taking all 3 branches, presidency, Congress, and the Senate. The Republican majority in the House is like 1 or 2 seats, easily could go to the Democrats. And on the Senate side, which most people feel the Democrats are at risk, we would note a couple of things. One, abortion is on the ballot in Florida and in Arizona. That should drive a lot of Democrat turnout. And then secondly, we noted an interesting factoid from one of the reporting services that suggests that Democrat challengers in key races in the Senate have significantly outraised their Republican counterparts in the first quarter. So money typically suggests energy. Money and energy together typically lead to better results in politics, and so that's really how we're setting up for what we think the surprise could be, a Democratic clean sweep.
Okay, let's move on to policy. And I saw Janet Yellen with a couple of comments. It was either yesterday, on Thursday or Wednesday, and she's a little bit worried about where the deficit actually is. Do you share her concerns?
It's interesting, right? Because we're clearly in a place where monetary policy is giving way to fiscal policy, right? Really been dominant since the great financial crisis. Monetary policy, central bankers have been the dominant players. Really, since COVID, it's been the fiscal side which has been dominant, particularly in the US, which is why we see that US exceptionalism, where, from 2019 through current period, US has grown much better, much faster than any of its competitors, in large part because we were more aggressive on the fiscal side than virtually any of our competitors. And so that's left us with, yes, a fiscal deficit of 6% or so during a time of full employment, which is very, very unusual. And I think one of the reasons why people have just continued to underestimate the growth profile of the US is that they just don't think about a big deficit at a time of full employment. But here's the key from our point of view. The key is that fiscal deficits as a concern tend to be slow moving. They have a long fuse, as we say, and they burn slowly. So in other words, our period of focus is 2023 to 2027. And in that period, we do not expect that the US fiscal situation is going to create tremendous upheaval around that and derail that pro-growth outlook that we have, that blue sky outlook that we have. So that's really, really important in the policy space. The other thing that's really interesting that we spend a fair bit of time on is the importance of immigration to growth in most of the major economies around the world. And the setup is quite simple, namely that the working age population in most countries is declining. The US working age population, for example, peaked about 10 years ago in 2015. In fact, the bulk of the new job growth that we've seen since COVID has been from immigration. And so the combination of immigration, more people working, and fiscal spending are the two main drivers to the US growth profile of the last couple of years. Of course, the fiscal situation, you just mentioned Treasury Secretary Yellen, and the immigration issue. Of course, we have one of our two candidates who wants to do a massive roundup of all these immigrants and deport them. Now, besides just what that means for us as a country, we should start to think about what that means for the economy, because if we took away millions of workers, because these immigrants are working, if we took away millions of workers, what do you think would happen to demand? What do you think would happen to the price of labor? What do you think would happen to inflation, et cetera? So one of the points we make in terms of policy is that who's ever going to win, whichever of our tripolar regions, Asia, Europe, the Americas, who's ever going to win this next decade, it's going to be the region that understands that they need to pivot from immigration as a curse to immigration as a must-have.
Let's move on to the last point, markets. Now, last week we talked about how the market hadn't really done anything in 2 weeks, and essentially here we are again today. This week it's essentially done nothing, but this is a monthly review, so it was small down for the month. Nothing crazy, but seems to be a lot of panic that went on there. How can you calm everyone from this, Jay?
Yeah, well, Scott, as a gentle reminder, my friend, we don't review the prior month. We focus forward at TPW. This is not a review of the prior month. This is a focus forward on the age of investment. And so when we talk about our investment approach, we're talking about how we think about it going forward. You will not find, actually, in this 7,400 words, one word about what markets did in April. Not one. Okay? What you get from us at TPW Advisory is a view into the future. It may not be the right view because we're obviously talking about the future. Much of Wall Street and most commentators love to talk about what happened in April. Why? Because it's a fact. It's easy. It's safe. They can't get it wrong. We don't bother with that stuff here. And we focus forward. And so focusing forward, we're happy with our asset allocation. Remember, in our global multi-asset model, we are overweight equities, overweight commodities, and deeply underweight fixed income. We continue to be zero weighted in developed market sovereign debt, zero treasuries. Remember that ag is 40% of our benchmark. So we have a huge benchmark risk, but we're allocating that money to commodities, which is the leading asset class year to date. We're allocating that money to an overweight in equities, which is the second leading asset class year to date. And so we've talked about we want to be in the picks and shovels, we want to be in semis, we want to be in the miners, we want to be in cyclicals because we think we're early cycle. We are exposed across the board on the commodity space. Within fixed income, deeply underweight. We are overweight credit, particularly high yield. And high yield tells us, by the way, there's absolutely no worries about growth because high yield spreads are super tight. That says no worries about growth. We're also exposed to emerging market debt, both local currency, which has suffered from the strong dollar. We think that's going to change, as well as Asian high yield, which is starting to really pick up nicely as people get more confident about what's going on in China. And so the big focus going forward for us, as we touched on, is the dollar, right? We expect the dollar to weaken. And as it weakens, in part because of the US and this inflation fear and stagflation fear, that's going to go away. Productivity growth, remember, macro surprise number 2 of our 4 for 24 macro surprises. We are expecting productivity growth to help bring that inflation down. And so as rates peak in the US, as the dollar peaks, we think there's tremendous room for dollar weakness, which would give our whole commodity and emerging market positions another leg up. And by the way, and we'll finish here, it would be a real boost to the thematic space. And remember, we have a second model, which is our TPW 20 thematic model portfolio focused on future tech and climate. Future tech has been pretty good. We've had things like Bitcoin in there. That's done well over the last couple of months. We have cannabis in there. That's done well over the last couple of weeks with the U.S. changing its class scheduling or proposing to change finally after years and years. But what suffered is the climate side, in part because of what we talked about earlier with China really dominating that space. But we think lower interest rates should really be a nice boon to the thematic side as well. And that's something we're watching closely. So in the asset allocation stuff, really the thing that we're focused on, because we haven't changed our allocations in quite a while in any meaningful way, we're really focused on the dollar at this point. We're looking for the dollar to roll over and the rest of the world to start to recover, U.S. exceptionalism come down a peg, dollar weakness, rest of the world starts to really pick up. And that's the environment that we're set up for as we look into that bleeding future.
Well, Jay, what a great rundown as always. I look forward to this every month. I hope you have a great weekend, and I hope the viewers have enjoyed everything you've given us today.
Thank you, Scott, as well. Have a great weekend, buddy.
And for everyone else out there, good luck investing.